Hello traders, welcome back to Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the best trading view chart types. This includes the line chart, the bar chart, the volume footprint chart, the Heikin Ash chart, and the candlestick chart. Each of these chart types provides unique insights into the market movement that can significantly enhance your trading analysis. By understanding when and how to use each type of chart effectively, you will be better equipped to identify market trends. You would also be able to understand how to manage your risks and improve your overall trading performance. Make sure to watch until the end of this video to fully grasp how each chart type can benefit your trading strategy. So we'll start by understanding the line chart, and we would have to switch our chart to the line chart. Now, the line chart is one of the simplest and most effective tool for analyzing market trends. This connects close price over a given period with a single line. As you can see, it connects the close of each price over a single line, offering a clean and straightforward view of price movement. This simplicity makes them ideal for identifying long-term trends. As you can see, it is very easy to deduce the trend of this chart. You can also use it to spot major support and resistance levels without retracing or intraday volatility. You can see it is very easy to spot resistance and support levels. As you can see, this is a support level, this is a resistance level. It makes it so easy to spot these levels on your chart, and we can see over a long period of time. Even if we change the time frame to the daily time frame, whatever time frame, it makes it easier to spot the support and the resistance and the direction of the chart. This is what is used for. When you are making use of the line chart, you fully focus on the closing price, which many traders consider the most significant price point in any time frame. By filtering out the highs, the lows, and the opening price, the line chart gives you a clearer picture of the overall market direction. This clarity can help you spot trends, early trends, and make informed decisions about when to enter and exit trades. Take a moment to look at the chart on my screen. Notice how the line smoothing out and connects each closing price. You can see how smooth it is, creating a visual representation of the market movement over time. You can use this simplicity to draw your trend lines and to identify areas where you can use it to draw the trend line and to also identify areas where price constantly reacts from. This is basically what these line charts can help us identify. Line charts are also incredibly useful for analyzing historical data by observing past price movements. As you can see, if we zoom our chart in, we can see we can observe historical price movement dating back to as far as wherever your time frame is able to take you to. Whether you are planning on a short-term trade or a long-term trade, it helps you to predict and identify patterns to help predict future trends. As you analyze this type of chart, remember that it is not just about spotting trends. It's about using those insights to refine your trading strategy. You combine your line chart with other tools like the pivot point or moving average. You can combine this with the moving average or pivot point. It helps to it helps to set a precise entry level. As you can see, combining this with our moving average helps to set a precise level for entries and exits on your trade. This approach minimizes risks while maximizing potential profits. So this is how we can use the line chart to our advantage. The next chart type we'll talk about is the candlestick chart pattern. The candlestick chart pattern is among the most popular and informative charts that that is used by traders worldwide. Unlike the line chart, the candlestick chart provides a more pictured representation of the price action within each time period by displaying 4 key points. It displays the opening of price, it displays the high of price, it displays the low of price, and it displays the close of the price. So this typically explains the detail of what is happening in present time using the candlestick pattern. This comprehensive view allows you to gain deep insight into the market psychology and potential price movement. The body of the candle would deduce the opening of the price, the high, the low, and the closing area of the price. Each candlestick tells us its own story through its color, real body, and wick. The color instantly communicates whether buyers or sellers are in price during that period. The green candle stick indicates bullish movement, while the red candlestick indicates bearish movement when price closes lower than its opening in case of a bearish candle. The real body represents the range between the opening and close price, while the wick or shadow shows the highest and lowest price reached during that period. The wick shows the highest and lowest price reached during that period. The size of the candle provides valuable information about market momentum. The size of the candle deduces what happened during the price, and it deduces the momentum in price. Large bodies indicate strong momentum, while the smaller body indicates or suggests weak momentum. When you see a very small body with almost no body at all, this is called a doji. A small body with almost no body, this particular example is called a doji, which signals indecision in buyers and sellers reaching a temporary stall state. This is an example of the doji with little or no body. What makes the candlestick powerful is the ability to form recognized patterns that can help predict future price movement. Patterns like the bearish engulfing, where a large red candle completely engulfs the previous green candle, often signals a potential downward reversal. This is what it signals. Similarly, a bullish engulfing, which consists of a large bullish candle following a small bearish candle, signifies a strong bullish momentum or a strong upward move. Other powerful patterns include the evening star, three black crown, and the hammer. Each pattern provides unique insights into market sentiment and potential trade changes. By learning and recognizing these patterns, you can make informed trading decisions and potentially identify high possibility trade setup before they become obvious to other traders. When analyzing the candlestick pattern, remember to always consider the overall market border context. A pattern that appears during an established trend carries more weight than the one that happens during a choppy or sloppy market action. A sideways moving price action is less reliable compared to a trending market chart pattern. Mastering candlestick takes practice, but insight it provides into the market psychology makes them an invaluable tool for traders at all experience levels. By understanding what each candlestick represents and how pattern forms, you gain a powerful advantage in anticipating potential market movements and identifying optimal entries and exit points. The next chart type we will be talking about is the bar chart type. The bar chart type is a different pattern, is a fundamental tool of analysis. It helps us to deduce. Let me set this in a way that it will be visible for all of us to see. Very good. This technical analysis provides a comprehensive view of price movement. Unlike the line chart, the bar chart displays 4 critical price points for each time period. It signifies the opening, the high, the low, and the closing of price. This detailed representation allows you to gain deeper insight into market behavior and make more informed trading decisions. Each bar consists of a vertical line closing showing the price range from the highest to the lowest point reached during that period. The horizontal tick on the left side of the bar marks the opening price. The horizontal tick on the left side marks the opening price. Let's see what we're talking about. This horizontal tick at this area in the bar chart. While the closing price is the horizontal tick by the right side, which indicates closing price. The simple yet powerful structure tells you exactly how price moved during that specific time frame. The relationship between 4 price points reveals important information about market sentiment. When the closing price is higher than the opening price, it suggests buyers are in control and it is called a bullish bar. This often colored green to make them easier to identify. Conversely, when the closing price is lower than the opening price, it indicates sellers are dominated, forming a bearish bar, typically colored the red bar. The length of each bar also provides valuable insight into market volatility. Long bars indicates greater price movement and higher volatility, while short bars indicate more stable and less volatile condition. By analyzing these characteristics, you can better understand the market dynamics and potential trend development. Bar chart excels at helping you identify important patterns that may signal future price movements. For example, an inside bar where the current bar high and low is contained bar inside the previous bar range often indicates decreasing volatility and potential for a breakout. This is what the inside bar is all about. While similarly, an outside bar which completely engulfs the previous candle, an outside bar that completely engulfs the previous candle may signal potential trend reversal. This is what it means. What makes the bar chart similarly or particularly valuable is their balance between clarity and details. They provide comprehensive price information without the visual complexity that can sometimes make other chart types overwhelming. This makes them ideal for both new and experienced traders who want to analyze price action effectively. When using the bar chart in your trading strategy, pay attention to the position of closing price relative to the bar range. You always pay attention to the closing price. A close near the high suggests strong buying pressure. Close near the high suggests strong buying pressure, while a close near the low indicates strong selling pressure. When it close near the low, it indicates strong selling pressure. Bar chart can be used across different time frames, from monthly to weekly to the daily time frame. You can also analyze on the minute chart for day trading. By mastering how to read the bar chart, you will add a powerful analytic tool to your trading arsenal that can significantly improve your ability to identify trends, spot potential reversals, and find optimal entries and exit points. The third chart pattern we are going to talk about, the fourth pattern we are going to talk about is the volume footprint chart pattern. The volume footprint chart pattern. If you change your chart to the volume footprint chart pattern, it represents, as you can see on the chart, this represents one of the most advanced charting tools available in TradingView. It offers traders unprecedented insight into the market dynamics. This is typically what it talks about. Now, unlike the traditional chart pattern that shows simply the price movement, the volume footprint chart displays the distribution of trading volumes across different price levels within each candle. The powerful visualization reveals exactly where buyers and sellers pressure occur, helping you to identify potential support and resistance areas of significance in your trading activity. At its core, a volume footprint chart characterize volume as either buy or sell based on the direction of price movement. When you look at the chart type, you will notice that each candle contains a detailed information. By default, seller's volume appears on the left of each candle, typically red, while buyer's volume display on the right, typically green. This intensive of these colors indicates relative strength of buying and selling pressure on each chart, on each candlestick. One of the most valuable aspects of the volume footprint chart is the ability to detect imbalance in price. An imbalance occurs when buyers' volume significantly exceeds the selling volume. That is when an imbalance in price occurs. TradingView implements identifications, helping to identify these levels of imbalance by comparing volumes between adjacent price levels, marking them with vertical lines. As you can see, it marks them with a vertical line beside the candle. This imbalance often signals potential price reversal or continuation. The chart also display important reference points like the value area. It indicates the value area. It also represents the range where 70% of trading volume occur within each candle, marked by a value area high and a value area low. So this is what it's about. While it also indicates a point of control. This indicates the price level which the highest trading volume occurred. Point of control where the highest trading volume occurs in price. You can see this horizontal line in this area. When analyzing the volume footprint chart, pay special attention to the relationship between price movement and the volume distribution. Strong price movement supported by high volume in the same direction generally indicates healthy strength. And as we can see, since we are trending to the upside, we can see a high bullish volume in the chart. Conversely, when price moves in a declining volume in the opposite direction, it may signal potential reversal. When there is a declining volume, it might indicate a reversal. This is typically what it means in price. When there is a declining volume, as we can see in this area, it indicates a potential reversal. To get the most from the volume footprint chart, consider using the delta view. The positive delta view appears green while the negative delta view appears red. This view makes it easier to quickly identify which side is controlling the market. The color of the candles indicates which side is controlling the market. The volume footprint chart is particularly effective for validating breakouts and identifying potential reversals before it becomes obvious on a regular chart. When price breaks through a key level on the chart, the breakout is more likely to continue when using the volume footprint chart. Similarly, if price is making a new high but with a declining volume, the divergence may signal a potential reversal. When price is making a new high or a new low with a declining volume, it may signal a potential reversal. And at this area, when price was making a new high, here you can see the volume was declining and it ended up reversing and breaking the previous low at this area. Even if it wasn't sustained, it's just to get the idea of what we are talking about. While extreme powerful, the volume footprint charts are available only to TradingView Premium subscribers and work best with a liquid instrument like the Forex major pairs, popular cryptocurrency and active traded stocks. These insights provided into the market structure and order flow can significantly enhance your trading decision by revealing the true buying and selling pressure behind price movement. The next chart type we are going to talk about is the Heikin Ashi type chart. The Heikin Ashi type chart. This represents a powerful modification of traditional candlesticks that is designed to help you identify trends easier and make more informed trading decisions easier. The term Heikin Ashi comes from the Japanese word that describes or means average bar, reflecting on how this chart smooths out price movements by using a modified formula based on two moving average instead of an open close and high, it uses an inbuilt moving average. Now, what makes the Heikin Ashi chart particularly valuable is the ability to filter out market noise and present a clearer picture of the prevailing trend, as we can see on my screen. Unlike the traditional candlestick, these display exact price movements. The Heikin Ashi candle are calculated using a formula that incorporates data from both current and previous periods. The opening of the Heikin candle is set to the midpoint of the previous candle. The opening of a Heikin candle is set at the midpoint of a previous candle. The calculation method creates a smooth chart that makes trend more visible and appears easier to follow. When analyzing Heikin Ashi charts, pay attention to the color and the structure of the candle. A sequence of green candles indicates uptrend, and a sequence of red candles indicates a downtrend, as we can see from my screen. One of the most effective ways to use the Heikin Ashi is for trend identification and trend continuation. Remember, when you see consecutive red candles, it signals selling pressure, and when you see consecutive green candles, it signals bullish pressure. The Heikin Ashi also excel in signaling potential trend reversals. When you notice the candles with small bodies and both upper and lower shadows appearing after a strong trend, is about to indicate a reversal. This is exactly what it means. After a strong trend to the downside in this area, and you can see a candle showing both long and short shadows, it's indicating a reversal is about to take place. For example, let's see how we can apply this to our trading, considering using the Heikin Ashi chart in combination with other technical indicators for confirmation. For example, if you want to enter a long position with the Heikin Ashi candle, you have to wait till it turns green. Once it turns green, after a pullback in an established uptrend, remember this has to be an established uptrend, creating higher highs, higher lows, higher highs. Once it turns green, you would enter your long position. Once your candle begins to turn green, this is where you would want to enter your trade. You put your stop loss just below that low. This is an area where if price gets to that area, it will invalidate the setup. So this is where you have to place your stop loss. Whether you are a day trader or a swing trader, this chart pattern help you to visualize trend more clearly and with more confidence to your trading decisions. By incorporating the Heikin Ashi into your technical analysis toolkit, you can gain a powerful method for identifying trend, spotting potential reversals, and ultimately improving your trading performance. Don't forget, you can combine all these chart patterns with indicators such as your moving average to add more confidence to your trading setup. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on your notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.